Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. I looked at Scottish and Southern Electricity the other week and found that they were making some big moves in unfamiliar places for them. And in comparison, National Grid really are a standard electricity and gas utilities company. Most of their income is from the transmission and distribution of electricity and gas in the UK and also in the US. So for both their electricity and gas networks in the UK, they transmit the electricity from the power stations to where it's required. And then they also act as system operator, where they make sure that the amount of electricity or gas produced at any given time matches exactly what's needed in real time. Their US gas and electricity network is based in 3 regions, which are New York, Massachusetts, and Rhode Island. And actually, their US business accounts for 42% of their overall operating profit, which nearly matches the 40% they're getting from UK electricity and 11% from UK gas. So when I compare them with Scottish and Southern Electricity, they really have stuck to their bread and butter, and they are operating as a slow and steady utilities company. These are monopoly situations, so these utility companies like National Grid, they have lots of assets in the electricity and gas networks, and these bring back a very predictable and reliable income every year. But because it's a captive market and a monopoly situation, you see that they really have stuck to being a utilities company through and through. They do have a National Grid Ventures branch, and this is only really though a small percent of the overall company, and that has some renewables projects, energy metering, liquid natural gas storage, and electricity interconnectors. That's where you transmit power from between countries, so between the UK and Belgium, for example. And of course, France supplies lots of electricity to the UK because they've got lots of cheap nuclear, and that's all done through undersea cables. So yeah, so they're also into this electricity interconnectors business. But this National Grid Ventures, it's like a incubator really of new potential revenue lines. So it has to be said that the share price is relatively stable, and when you go back 5 years, there's only a 33% difference here, top to bottom, and it's been fairly steady since 2018. It actually dropped mainly up to 2017, and this was in conjunction with them selling their gas distribution business for 3.6 billion. When they did this, they returned most of the proceeds as share buybacks as well as special dividends. And this, you have to say, perhaps was a mistake, because look at how the share price went down. And actually, as we'll see later, the revenues went down as well. So that was probably a bad move. Then around 2018, they've come to agreements with the US regulators for how much they're allowed to make in the Massachusetts, Rhode Island and New York areas. And also they had to commit to how much capex they were going to spend securing those networks in exchange for the money they were allowed to make. So that was the important news at the end of 2017 and in early 2018. And most of the news flow since then has been related to the Rio II price controls. So this is the consultation with the regulators Ofgem to agree on how much they've got to invest in a network and how much profit they're about to make. And that really is most of the main news flow ever since 2019. One thing that happened in 2019 was they switched on their Nemo link, which is their Belgium interconnector line. So their interconnectors are part of the National Grid Ventures bucket. And here you can see they're building interconnectors with Norway, Denmark, France and Belgium. And in the future, for this 2.1 billion total investment, they'll get income for many years to come with this significant gigawattage of electricity flowing. Of course, in the future, I expect there'll be larger disparities between the energy required and produced in different countries due to what's going on with the green agenda and how the governments are pushing that to be carbon neutral by 2050. And it's quite interesting, if you go onto the NemoLink website, they've got a nice little graphic here, and you can click on each interconnector. Currently there's only the Belgian one, but you can click on them and it tells you exactly how much energy is flowed in the last hour. So here we see nearly 1 gigawatt flowed from Belgium to the UK in this interconnector. So I think that's quite a nice little add-on business that they're setting up for themselves. But then most of the news flow has been around the Rio II, and frankly, they're certainly saying they don't think they've got a good deal with Rio II. They're complaining. They're saying that they're going to appeal the decisions. So I've got here one of their RNS from 2nd of March where they talk about the Ofgem's Rio II final determination. And they say that they're still going to pay a dividend in line with inflation. And bear in mind, they've got quite a good dividend at the moment. But they do complain about the deal. Now, of course, it's their job to say it's a really bad deal to try and get the best deal they can. But certainly the messaging we get is they don't think it's a good deal. And they say that they're going to have to spend 10 billion in capex over the next 5 years in order to build in all the requirements that are going to be needed just for general safety, but also because it's expected that there'll be a doubling of the electricity requirements in the coming decades. And so, they need to upgrade the electricity infrastructure to support that. So looking at the profit and loss, and there's a fairly high income of around 15 billion every year. Obviously in 2017 there was a 6 billion income from when they sold their gas distribution business. But you can see that after they sold that business, their operating profit seemed to have dropped. But you can see that after they sold the gas business, their net income seems to have dropped generally. It was only 1 billion in 2020 when it used to be more like 3 billion before. So really, when I look at their profile here of their revenues and their net income, it looks bad, basically. I mean, it's dipping down. In their 2021 interims, they actually stated that their underlying profit was down 11%. And this has been attributed to the COVID measures reducing people's electricity usage. Despite this, 1 billion a year is a lot of net income to be bringing in. So that's certainly positive. But yes, the overall trend is a fall in their net income. If you look at that graphically, you can see how there's a real narrowing of the gap between their income and expenditure. So that isn't a nice profile. And the message I've got from looking at the Rio II information and looking at what they need to do in response of the green agenda and the government's green agenda is they're going to have to be spending a lot of capex in the next 5 to 10 years. So you can expect their net profitability to be reduced for quite some years until the electrical infrastructure is set up for the future. When you look at their revenue by sector, you see that the US regulated actually accounts for the majority of their revenue, and then UK electricity is the next significant thing. You can see here how after they sold that gas sales business, the revenue for their UK gas, dropped significantly, and is now fairly meaningless along with the National Grid Ventures business. When you go down into operating profit, you see how most of their profits are from UK electricity and US regulated gas and electricity. And then the UK gas, you see it drop there after they sold their gas distribution business. And you can see it's down there around 400 million a year, along with the National Grid Ventures down there. It's interesting to look at the capex spend in 2020 versus the operating profit. You can see here their underlying operating profit in a chart, in a bar chart format. And here you can see the US regulated and the US electricity being the mainstay of that. And then here you can see the capex they need to keep ploughing in every year in order to achieve those operating profits. And you can see that they've been having to spend a lot of money on the US regulated part of the business, and then also in the UK electricity. So their net assets are around 20 billion. And there's a few things I can eke out. I mean, there's so much here, but actually year on year, it's a very similar fingerprint. What I can eke out, for example, is you can see the financials and investments, and you can see a massive gain there of 9 billion in 2017. That was related to them getting ready to sell their gas distribution business. I also noticed that their pensions liabilities are around 2.8 billion, and their pension assets, there's a trend of it going up from only 400 million to about 2 billion in 2020. But unfortunately, there's a deficit overall with their pensions assets, because their pension liabilities are 2.3 billion, where their pension assets are 1.8 billion. And so although that's only a small overhang when you look at the overall size of this company, I do like to see if there's any pension overhangs. It's one of the negative things I like to know about. But apart from those, as I say, the financial fingerprint seems to be the same every year. I kind of visualize this as, because this is a huge Goliath of a company, but the nature of their company, the nature of their business is very stable. It's lots of highly capex intensive assets, which is basically the electrical utilities infrastructure. And they have this massive, huge Goliath of electrical network, which is most of the business, and gas distribution network. And really that kind of stays similar in footprint year on year. And that kind of reflects how they are a utilities company. Very notable is that they're 27 billion in debt. Really, that's a lot of debt, and that's kind of explained though by the fact that their future earnings are perceived as being very safe, and they have massive assets which will always kind of retain their value, because whoever owns them, there's always going to be the entire population of the UK needing electricity just to live. So I think this huge asset base of their gas and electricity infrastructure, plus their very impressive income of around £1 billion a month, around £1 billion a year, which is considered safe future revenue stream. This is how they get away with holding 27 billion in debt while still having a reasonably good credit rating. It's notable that the debt is approaching half their assets, and I did a comparison with Scottish and Southern Electricity. Now, normally SSE have about a billion in net income, although it was only 0.1 billion in 2020. But if you could say normally it's about the same. They have same dividends as National Grid, but Scottish and Southern Electricity only have 9 billion in debt versus National Grid's 27 billion in debt. So that was an interesting comparison. However, of course, SSE are a little bit more maverick in how they're buying up loads of electricity generation assets, and there's massive movements on their balance sheet. So, there's perhaps more risk there compared with National Grid, who are, I think, being a lot more steady-footed and conservative in their approach. So I looked at the statement of cash flows, and National Grid are generating 2.8 billion from their normal activities of handling gas and electricity supply. They have 0.5 billion from environmental charges. Now, this is an interesting thing where a lot of that electricity wasn't from renewable sources. It gets subject to special taxes that the government introduce to encourage the use of less efficient renewable energy. And then strangely, although that's a cost, it comes through as positive on their statement of cash flows because it can be deducted from their taxes they pay. And there's 1.6 billion of depreciation, amortization and impairment charges. Now, these are also a positive cash flow. When I did the Scottish and Southern Electricity analysis, I didn't understand what that was. Here's the video I did for that, and I have to thank very much the Hayes TV for giving me some feedback on what that was. Really appreciated that. I also took a look at Investopedia, and here they give an explanation of why the depreciation, amortization and impairment is a positive cash flow. When you make a capex investment, that will initially be negative in terms of cash flow, but it then leads to an increase in your assets. And then what companies do is, over the lifetime of those assets, their values depreciate, and then each year you deduct from your assets this depreciation, and then what happens is you can actually deduct from your taxes these depreciation of your assets, and so that's why it then comes in as a positive cash flow. So that explains why there's a 1.6 billion of depreciation, amortization and impairment charges. And I appreciate the feedback I got there. Thanks to Hayes TV. It's good to know because this is a very large part of the actual positive cash flow. They raised 2 billion from disposals, which was from selling some of their gas assets, which was called Quad Gas Holdco. And they actually raised 4.2 billion of new debt, which provided positive cash flow. So that's overall around 11 billion of positive cash flow. And then they had 1.2 billion of miscellaneous financial charges. Then they had to pay only 0.2 billion in tax. They made new capex and investments of 4.6 billion. And as we know that they're going to continually have to invest a lot more capex in the next decade in order to support the changes that are expected to the national grid. Now, on the debt that they have, this 26 billion of debt, they're actually paying 1 billion a year just in interest on that debt. And they paid off 3.3 billion of debt in 2020. And finally, they paid 0.9 billion in dividends. So overall, when you account for rounding and stuff, there was a 0.2 billion cash burn, and they've only got 0.1 billion left in the bank. So overall, when you consider the overall general scale of the company, and how reliable their future income is, it's a fairly reasonable statement of cash flows. But I have to say it's fairly tarnished to me. I don't like the interest payments. I don't like the debt situation. They're taking on more debt every year in order to pay for what they want to do. So it's just like a bad general trend. And so overall, I think their statement of cash flows is fairly reasonable for a company of their type and size. But it certainly isn't. It's not like it doesn't blow me away as an amazing situation in terms of how the money's flowing around. With some stocks I've looked at, when I look at the statement of cash flows, it just looks amazing. It's very compelling. They're clearly winning. With National Grid, it's more like they're clearly getting on by fine. It's not really a compelling buy message when I look at their statement of cash flows, because there's a few little niggles here, particularly around their debt and interest payments, and the kind of quality of the cash coming in. So the profile of their equity, and it's mostly retained earnings and a fairly flat profile. There's not really much else to mention there apart from this other equity reserves, which is a negative value. And I think that it would take 2 hours to go into in detail. But the gist of it is it's related to previous mergers that they've undergone, and how the value of the intangible assets and things related to those mergers are accounted. I don't really understand it, but it's kind of a minor component, really. But that's one noteworthy thing. But otherwise, it's fairly standard profile. I've created a chart here of their market capitalization versus their value, and it's a nice. They look actually generally fairly reasonably valued when I look at this. They've got a price to book value of 0.7 by my calculations, but of 2 to 1 according to Reuters data. Their revenues are 2 to 1 ratio. You can kind of see here on this scale how nice and steady their revenues are over time. And their net income is a 24 price to earnings ratio. So when I consider this to lots of other stocks I've looked at, this graphic, they do look like a reasonable buy. They don't look out. They certainly don't look outlandishly priced when you look at this. If you go on the London Stock Exchange website, you can get a company tear sheet, and on here we can see some nice summaries of different valuations, and you can see here, compared with other companies from the same sector. Now, some of these sectors actually include more water utilities, but all the same, you can see that in terms of price to earnings, they're fairly cheap. In terms of enterprise value, they're fairly reasonable. In terms of price to book, they're the cheapest of all of them. In terms of price to cash flow, they're not bad. In terms of dividend yield, they're the best. And in terms of price to sales, they're fairly cheap. So on this analysis, they do look good value, actually. So here's my sector velocity thing, and the only two companies that fitted the classification of being electrical utilities were Scottish and Southern Electricity and National Grid. And I looked at their historical market capitalization to try and get some overall trend patterns I could look at to compare with against the FTSE generally, and that's this blue line here. Now, it's extremely hard to get that data. You can't even do it by digging out the old annual reports because they only seem to go back 10 years when you go on their websites. So using data I got from HSBC, here you can actually get a sector map or sector trend in comparison to the FTSE 100, and this goes back to 2003. It doesn't go back as long, really I'd like this going back 40 years would be better, but still that's longer than what I'd achieved before. And when I align, now the problem here is it does include water utilities, but when I compare my data with this data for the same time period, I got the same pattern. So that means I'm fairly comfortable with this throughout the whole time period. And actually, there's only really a couple of trends I could pick out. One is that for some reason between 2009 and 2017, the utilities sector outperformed the FTSE quite significantly. Other than that, it just really tracked it. But there's an interesting thing where before the end of the bull market that concluded with the banking crisis, in the 2 years before, you see utilities absolutely shot up in value compared with the FTSE generally, which itself was going up quite a lot. So and then the same thing happened just before the Corona crash. There's a massive spike preceding the Corona crash in utilities. Now that is a very interesting pattern there. That could be a very, is that some kind of way that you can look out for future crashes? Obviously you'd have to spend a lot more time before you built that into a clear kind of tactic, but it's definitely, that is definitely a little pattern I noticed that seems above the general noise and just worth noting. But generally, really, all you could say is, in the recent boom, actually, if anything, the utilities have been going down in value, whilst the stocks have been going up after the COVID crash. And other than that, the general trend is probably down since 2017 for utilities. And if you do think about it, that does make sense in that there's a lot of investment, the amount of electricity required is going to go up, apparently double before 2050 because of this, the impact of all this renewable energy policy. So it does make sense that actually so it does make sense that the gas and electricity utilities companies will suffer because they're going to have to invest loads to upgrade the infrastructure to pay for all this. Plus, they've then got the government hobbling them with, because they're a monopoly, fair enough, but you've got the government fixing how much they can make. So it does that narrative just kind of makes sense. I don't know about all the way 2017 though, but still, yeah, I'd probably end up saying not enough clear understanding and data to make a decision based on this, but certainly a couple of interesting insights there. So very recently in March, they gave an investor call where they explained their response to the Ofgem Rio II final outcome. And these are some slides from this investor update. And essentially they confirm that due to COVID, there's going to be a 400 million headwind in underlying operating profit, and the cash impact on the business will be 1 billion in 2021. And they stated that because of the Rio T2 price controls, they'd be having to make more investment, and they'd be seeing lower returns. So this really is signposted bad news, frankly. There might even be a downgrade of their investment rating, their credit rating. We had a nice and cold winter in the UK, and so the profits from the gas transmission actually went up, but everything else is going down. Their underlying profit overall was 12%, and you can see the profits in UK electricity, US regulated, were down 10 and 22% respectively. So so in their interims there was generally a downturn in their revenues, which they blamed on COVID and people using less electricity. And then we've got the Rio T2 determination being negative at the end of the day. So overall, I'm fairly happy with National Grid's general policy. They are sticking to their bread and butter of being a electricity and gas utilities company. They have a very solid 1 billion coming in every year in the future, and they have lots of assets, and they really, to me, are a steady ship. So there are some flies in the ointment, particularly the debt that they have, 27 billion. The fact that, a lot of their negative cash flows aren't the kind of things I like to see, interest payments and things like that. And we have this negative news of the Rio T2, and the fact we know they're going to have to spend lots of money investing in their networks to meet the future renewable demands. Despite the huge dividends and the future safety and revenues, there's too many negatives for me to want to invest in National Grid. But they certainly have helped me learn a lot about the energy networks and how that could apply to renewable energy. And so it's certainly been very worthwhile to spend the time to research them. So now to continue with my Gretta Gold journey, and the next companies I'll be looking at will be Greencoat, who invest only in UK wind farms, and ITM Power, Sirius Power Holdings, and Techmar Group PLC.